All right, class. Welcome. Today, we're going to jump into a really critical area of tax planning, how people use corporations to transfer money. We're going to look at a case study that shows how a smart strategy can work beautifully, and how one tiny mistake can make it go horribly, horribly wrong. Let's get into it.
And just a quick note before we begin, all the materials for this explainer were prepared by Dr. Samir Al-Rishani with some support from AI.
So here's the big question we're tackling. How can someone who makes a lot of money, legally, share that income with their family, say a son or daughter, to lower the whole family's tax bill? But more importantly for us, how can this seemingly clever plan backfire and turn into an absolute tax nightmare?
Okay, so let's start with the why. You might be wondering, why would anyone go through the trouble of setting up a corporation and loans and all that? Well, it all boils down to a pretty common goal for high-income families.
To make this real, let's talk about Dr. Chen. She's a successful doctor, she's in the highest tax bracket, which means any money she invests gets hit with a huge tax bill. Now, she wants to save up for her son David's university education. The big question is there a smarter, more tax-efficient way to do it than just saving the money in her own name?
And that brings us to the strategy itself. We're going to walk through how this is supposed to work. The ideal plan, the perfect world scenario for Dr. Chen.
So here's the game plan, step by step. First, Dr. Chen gives an interest-free loan to a brand new company called David Corp. Her son, David, is the only shareholder. Step 2, David Corp takes that money and invests it. Then, the corporation starts earning investment income. And finally, after paying its own taxes, the corporation pays out dividends to David.
The goal here is super straightforward, right? We're trying to shift that investment income out of Dr. Chen's hands, where it would be taxed at maybe 50%, and move it into David's hands. Since he has almost no other income, he'll pay tax at a much, much lower rate. It's a classic income-splitting play. But the real question is, does it actually work?
Well, this is where our story takes a very sharp turn. This is the fork in the road, everyone. The success or failure of this entire strategy hangs on one single, absolutely critical detail that, as an advisor, you have to get right. And it's all about the type of corporation being used.
And here it is. This slide lays out the two paths. If David Corp qualifies as a small business corporation or an SBC, then congratulations, the plan works like a charm. Income splitting is a success. Now, what's an SBC? Generally, it's a Canadian-controlled private corporation where pretty much all of its assets are being used in an active business in Canada. But if the company is not an SBC, say it's just a holding company for stocks and bonds, the whole thing fails spectacularly. The attribution rules kick in, and the result is, well, it's punitive.
So what are these attribution rules I keep mentioning? Think of them as the Canada Revenue Agency's anti-avoidance toolkit. They exist specifically to stop high-income people from just shifting investment income over to a spouse or a kid to dodge taxes. The rules basically let the CRA look at Dr. Chen and say, nice try, but we're going to pretend that income was earned by you all along, and we're going to tax you on it.
So let's really dig into what punitive means here. When this plan goes wrong with a non-SBC, it's not like the CRA just says, oops, that didn't work. Oh no, it's so much worse. It creates a financial train wreck, a triple tax situation. That's right. 3. The same stream of investment income ends up getting taxed not once, not twice, but 3 separate times. Let me show you how this cautionary tale unfolds because you need to see this.
Okay, let's count them down. Tax hit number 1 is on the corporation. David Corp earns that investment income, and as a separate legal entity, it has to pay corporate income tax. Simple enough. That's 1.
Next up, tax hit number 2. The corporation takes its after-tax profit and pays it out to the shareholder, David, as a dividend. David then has to put that dividend on his personal tax return and pay tax on it. So far, this seems pretty normal for a corporate structure, right? But wait for it.
Because here comes the killer third hit. The attribution rule slams down. The CRA turns to Dr. Chen and says, because you made that interest-free loan for income splitting, we are going to deem that you earned interest on that loan at the government's prescribed rate. This phantom interest gets added to Dr. Chen's income, and she gets taxed on it at her highest personal rate, on money she never actually received.
And hey, don't just take my word for it. This isn't some weird, unintended loophole. The Canada Revenue Agency itself, in its own official guidance, calls this result punitive. This is intentional. It is designed to be a harsh penalty to scare people away from trying this with the wrong corporate structure.
So, let's bring this all home. What does this mean for you as a future tax planner?
what are the absolute must-know takeaways from this case study? Here's your checklist. First, the corporate status, SBC or not, is everything. It is paramount. Second, remember the CRA is always looking at the purpose of the loan. If it's just to cut taxes for a spouse or minor, that's a huge red flag. Third, never forget the penalty is a brutal triple tax. Fourth, know that this rule specifically targets benefits for a spouse or related kids under 18. And finally, and this is your golden rule, always, always, always verify a corporation's status before you even think about advising a client on this strategy.
And that leaves us with this final thought. In the world of tax planning, the line between a brilliant money-saving strategy and a costly punitive disaster can be razor thin. In this case, that line was just 3 little letters, SBC. Your job as a professional is to know exactly where that line is.